Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra, with me Shel Bhatnagar, and this is another wonderful edition of Market Masters where we bring to you the top voices of the Lal Street. Joining us today on this special is none other than Mr. Nilesh Shah, the MD of Kotak Mahindra AMC, joining in to decode for us what all of us have been trying to understand by way of GST cuts. What does it mean for the Aam Aadmi as well as for the markets and economy at large, and who better than Nilesh ji to help us all with all of that. Thank you so much, Nilesh ji, for being with us on this very special edition. And it's, always such a good insight that we seek from you, that this time we had to get you. There are so many aspects that we have to discuss with you. So let's start off with the first overall thought on the GST rationalization. What do you think of the next gen reforms in GST? What does it do for our economy, sir?
So the GST rationalization, Sakshi ji, is about ek tir kai nishan. First, it will support consumption as there will be more money in the pockets of consumers. Second, it will also bring down inflation as prices will drop. That will allow RBI to ease monetary policy further. Third, there is hope that with consumption demand increasing, at some point of time, private investments will pick up as capacity utilization will move, and a virtuous cycle of investment leading to consumption and consumption leading to further investment happens. There is also an agenda to stimulate domestic economy and safeguard it against the adverse impact of US tariff. Put together, this GST rationalization wants to achieve multiple things at one shot.
Right. Namaste Nilesh ji, and a very warm welcome to you. Apart from, of course, being the MD and CEO at Kotak Mahindra Asset Management Company, Nilesh ji has another very important designation which is a little more relevant to this show. He is a part of the Prime Minister's Economic Advisory Council, and a lot of his inputs, I am very sure, would have been considered by the council. Nilesh ji, a question on how the market is interpreting these GST rate cuts. How do you see this working out in the medium term? We've had an income tax cut in February, an interest rate cut by the RBI by 100 basis points, and now this is an indirect tax cut as well. Put together, plus a good monsoon, how is it likely to impact the market over the next 6 months to 1 year?
Shelby, in some sense, markets have discounted the revival of consumption based on things which you mentioned. A tax cut which leaves more money in the pockets of taxpayers. Interest rate reduction which reduces EMI burden and leaves more money in the pockets of borrowers. The GST rationalization leaving more money in the pockets of consumer. There is also 8th pay commission coming into play somewhere in early 2027. And there is potential petrol diesel price cut if global oil prices support it. Put together, after taking several supply side measures, now we are trying to stimulate domestic demand. The hope is that it will partially offset the adverse impact of tariffs which US has levied on us unjustly.
Absolutely. Nilesh, you pointed out the right aspect. We did ask the finance minister as well as to the timing of this announcement, even though she did mention that from the last 1.5 years, we had formed the GOM and the discussions were on last 8 months ago. And from the budget time till now, twice the Prime Minister asked her, what are we doing on GST? And finally, it has actually come through. But a lot of this discussion was happening that this is probably going to cushion us from the impact of the 50% tariff. How do you read that, sir, and how do you explain it to the average investor at large?
So undoubtedly, when US levied tariffs unjustly and unreasonably, it was bound to have an adverse impact on us. We export about $80 to $85 billion of goods to US. As of today, about $50 billion goods carry 50% tariff. At 25% tariff, it is still bearable. because our competitors would have got about average 18 to 19% tariff. So the impact of 6% was bearable. But at 15%, we are one of the highest taxed tariff in the US, and it's an embargo rather than just increase in cost. Now, to stimulate domestic economy against that adverse impact, tax cuts are coming into play. Process improvement is also needed. There will be further easing of monetary policy probably to support investment and consumption. So we will take many steps, including finding alternate buyers for our goods to ensure that the adverse impact of US tariff is minimized.
Right. Nilesh ji, in the last 2 months, our foreign friends have accelerated their net selling on Indian equities. In August, $5.2 billion. In July, $5.4 billion. And of course, we are still net negative on year to date. What do you think is a problem with them? The reason why I ask this is this related entirely to US tariffs?
No, Shelby, if you notice, they have been selling for some time. One, they have made lot of profit in India. India allocation in their portfolio looks far higher. There is some amount of profit booking. Second, they have concern on valuation, as we were trading at premium to other emerging markets. Third, they were also probably doing a switch where they were selling old economy companies like banks, commodities, and moving into new economy companies whose IPOs were coming. We did see consistent selling on the secondary market, but also consistent buying in the primary market. And finally, undoubtedly, US-led tariff has also impacted decisions of foreign portfolio investors. There is also huge amount of negative coverage against India. We manage funds in America where retail Americans can participate. And today when we talk to our customers, our distributors, they do ask clarification on why India is importing Russian oil. And then we had to explain that we are not the only importer. There is far bigger importer than us in China. There is also import of goods from Russia by America itself. So clearly, this kind of negative media coverage also creates perception. So there is multiple things which have come together to result into FPI selling.
Absolutely. Now, Nilesh ji, help us understand when it comes to the revenue loss part that everybody is talking about. We've seen this year in the budget, the government is going to be taking a hit on account of the direct taxes as well. Now, with the indirect taxes, there's going to be another 40,000 crore rupees of a revenue outgo from their end. Will this at all result in any upsetting of the fiscal math, or will it be manageable? How are you looking at that aspect, sir?
So undoubtedly, there will be reduction in the revenue because of the tax cuts given. The income tax cut was factored into the budget last year. The GST tax cuts of about 48,000 crore for current year will be additional. But government has many means to increase revenue. Asset monetization, divestment. The PSUs have made huge profits and they have been declaring good amount of dividend. Some further dividend could come handy. The RBI itself declared a record dividend. So put together, government has many avenues on the revenue side. My feeling is that there will be marginal slippage on the fiscal deficit side, and that's more driven not by the spending, but because of the lower nominal growth. Despite a record first quarter real GDP growth of 7% plus, the nominal GDP growth was just around 8% plus. The budgeted estimate of tax revenue has been made on a 10% plus growth. So there could be some amount of denominator impact while calculating fiscal deficit, and that could have an impact.
Okay. Nilesh bhai, for fund managers such as you and equity strategists across the board, is life a little tougher after this, news that probably sanctions by the US will increase now on Indian IT and Indian pharma. As a seasoned fund manager, how are you navigating this market at this point?
So, Shelby, as of today, there is lots of noise, there's lots of rumors. We really don't have ability to predict future, neither we can react to the every news coming. What we have realized is that it's futile to predict future. Let's focus on a longer term. If tariffs are levied, that's the reality. We could not have predicted 25% or 50% number. It's also futile to predict whether it will get extended to IT services or pharma or not. We have to focus on our corporate who are working out within the domains of tariff to figure out how to grow. We are backing entrepreneurs who know there will be challenges, far more challenges than what we face as fund manager, and yet they are willing to grow, yet they are working hard to grow. There are enough domestic stories available which could provide opportunity. So we are ignoring the noise because it's difficult to predict them. We are focusing more on a bottom-up basis on our stocks, on our portfolios. Will there be short-term pain if tariffs remain for a longer period of time? Undoubtedly, yes. Will there be more pain if tariff is extended to pharma and IT services? Undoubtedly, yes. But Shelby, will it be a longer term in nature? Answer is undoubtedly no. Today, India supplies more than 40% of generic medicines to America, and it costs far less. It's just 10% of their pocket money which they spend on healthcare. Now, when you put tariff on that, there are consequences. The medical stocks in America are actually running at a lower level. Third, the distribution margin of medicine in America is far higher than what manufacturers make. Maybe a large part of this tariff will be absorbed by the distributors or passed on to the consumers. So there are many factors which will come into play, but we believe a good entrepreneur will find out a way.
Nilesh sir, what is your thought on this new world order that is being seen at this point in time? At the SEO summit, the signals that came in from there, the deeper ties that we are now trying to again form with China and with the other counterparts in Japan as well. How are you looking at all of this, and what could this lead to, sir?
So today, countries are becoming more and more selfish. We have seen how superpowers behave irresponsibly. The spirit of India's diplomacy is Vasudhaiva Kutumbakam. When we export generic medicine to America, we do make money. We do get trade surplus. But at the same time, we provide quality medicines at much cheaper prices and help save American lives. It is a win-win situation for both US as well as India. When we make software, we make competitive software for the world. We provide it at a reasonable prices. We provide 24/7 services and maintenance. There is no cyber security, there is no virus in those software. Imagine if this software was made in China. Would you be comfortable? Would you be confident that this does not carry any cyber risk? By building software, did India benefit? Undoubtedly, yes. But did US also got security? Undoubtedly, yes. And we are not talking about efficiency and cost. So India's relationship, India's diplomacy is about Vasudhaiva Kutumbakam. We win, you also win. I think that's the way forward. Today, big powers also have big responsibilities. If they obligate that responsibility, will they remain big power? Answer is probably no. We have seen demises of large states, large powers, because they became irresponsible. So let's hope better senses prevail. The Vasudhaiva Kutumbakam strategy of India is adopted by superpowers.
Right. Nilesh bhai, this is all very well explained, and this is all common sense. when companies deal with companies, nations deal with nations, they talk sense. But here is a gentleman who refuses to understand the basics of common sense. For a country which is on the back foot as far as medicine costs are concerned, you want a 250 basis point tariff. For a country which is dependent on Indian software engineers, you want to tariff Indian software services providers. So the point I am trying to make is that for people and professionals such as fund managers, there is another layer of unpredictability that has come into stock picking. Now, how to overcome that? One is that we ignore Mr. Trump for 3.5 years and then maybe hope for the best. But in 3.5 years, much will be lost.
So, Shelbhai, in the nation's history or a corporate life, 1.5 year or 3 year or 3.5 year is not a big time. Number two, adversity many a times brings best out of the company as well as country. We did see in the 70s when food grain exports or food grain grant aid to India was stopped under PL 480. We did suffer, but eventually we launched Green Revolution and India became self-sufficient in food grain production. In the 90s, we had to pledge gold to raise foreign exchange loans. It was kind of an insult for Indian asmita. We worked hard on exporting medicines, software services, and other things. And today we are having top 5 FX reserves in the world. So adversity does bring best. And as a fund manager, our job is to find that talent, that entrepreneurship, which will bring the best, which will do the best even in adversity.
Nilesh sir, help us now understand with respect to the opportunities that present themselves in front of our viewers right ahead of the festive season. We are betting big on this GST rationalization to bump up a lot of consumption-oriented demand across the sectors. Is it the right time to look at these sectors and start probably front loading our investments in them? Will it take time for demand to really pick up and the signal slowly? How would you advise an average investor to look at an auto, FMCG, consumer durable sectors?
So Sakshi ji, our recommendation to investors will be follow asset allocation. There is good opportunity in gold and silver. There is good opportunity in performing credit and long duration or long-term papers. And there is also opportunity in equity. In the short term, everything could be volatile. Gold is almost at all-time high. Silver is near all-time high. Yields are climbing up and equity markets are likely to be volatile. So one, be ready for volatility. Second, follow the asset allocation. And at this valuation and uncertainty, it is time to be neutrally allocated to equity. Don't be overweight, don't be significantly underweight. And within equity, should you put some money in consumer theme? Answer is undoubtedly yes. A large part of this is already discounted into the market, and which is why we are seeing buy on rumor, sell on news playing out. But this correction gives an opportunity to add into consumer discretionary, consumer space. We believe more money in the pockets of consumer will create its own multiplier effect. And wherever this money is going to get spent, for example, less likely to be spent on roti kapda, more likely to be spent on experiences like tourism, travel, hotel, airline, preventive medicine, education, and so on and so forth. So yes, it is time to be overweight consumer discretionary space, but ready for volatility and moderate your return expectation.
Right. Nilesh bhai, there is no better person than you to ask the next question. You started your life as a credit analyst and a bond trader. Globally, we see long dated bonds in deep problem. 30-year US, Japan, UK bonds are now having a yield of more than 5%. One, what are they telling the equity markets and central banks? And two, even in India, we saw the 10-year yield rise after the GST rejig was announced. Is there a fear that yields will go up further to 7.5% in India?
So globally, yields are rising because debt levels have gone up. Between subprime crisis in 2008 and COVID crisis in 2020 onwards, most countries' debt to GDP ratio has gone up. Some countries consumer debt, some countries government debt, but overall debt to GDP ratio has gone up. Now, as debt burden starts increasing, obviously investors are going to demand higher yield. Second, there is also a large amount of unfunded medical liability in US. A similar unfunded pension liability exists in Western world. Between unfunded pension and unfunded medical liability, people believe there will be more debt. Let me demand a risk premium. The third thing which is happening post subprime crisis, central banks had flooded markets with liquidity, kept interest rates near zero, and inflation was behaving well. Unfortunately, inflation started picking up post COVID. That pushed central banks to take out liquidity, raise rates. Undoubtedly, market also started raising interest rate. So a lot of it, what is happening globally, is function of higher debt, slowing down or becoming slightly tighter monetary policy, and also the fear of unfunded pension medical liabilities going forward. In India's case, our case is slightly different. We are the only major economy which has improved its debt to GDP ratio between subprime crisis and today. Government debt invariably has gone up, but both corporate India and household India has deleveraged. Second, the RBI has pumped enough liquidity into the system and cut rates. The market yields have indeed climbed by 40-50 basis point post RBI's rate cut announcement, but it is function of multiple things. One, there was a stance change by RBI from accommodative to neutral. Market's expectation was that there will be more rate cuts. Now, with stance change, that is kind of deferred. Hence, there was impact on yield. Second, we are also seeing some of the states borrowing in the auction. While the weighted average rate is on the lower side, the tail many a times is on the higher side. And that higher cutoff kind of sets next auction's level. Market yield is function of not only fundamentals but also sentiment and flow. The uncertainty coming from US tariff having impact on increased government supply if there is a need to fund, or support exporters, that also is playing in the minds of market. So I will say there are many reasons which has resulted into 10-year yield climbing up despite easy monetary policy by RBI. But I wouldn't put my money for 10-year yield to touch 7.5%. We think at current level of around 6.5%, it is fairly balanced.
Right. Nilesh ji, today is also a very special day. It is Teachers' Day, so we want to wish you a very happy Teachers' Day for constantly teaching us and our viewers all that we have learnt about markets from legends like you. I want to understand on this special day one investing lesson that you will never forget from your market guru, and one investing lesson that you want to impart to our viewers through this medium.
So thank you, Sakshi ji. I have also learned by interacting with various people, and they are all, we all increase our knowledge by sharing with each other. I would only like to tell viewers about one thing. When I had lost a lot of money in stock market early in my career, someone told me that, beta, दलाल स्ट्रीट में लक्ष्मी माता का पूजन दिवाली की रात को होता है, बट सरस्वती माता का पूजन रोज करना पड़ेगा if you want to make money. The path to Lakshmi Mata goes by worshipping Saraswati Mata. That's the rule of the market. And I will recommend all viewers to be inquisitive. Keep on processing information, keep on taking news. Suniye sabki, kariye apni. Do remember that path to Goddess Lakshmi passes by worshipping Goddess Saraswati.
Fantastic.
With that, Nilesh bhai, we'll call it a day. I'm sure after this answer, there are no questions left. And we hope for the best as far as markets are concerned. And we hope that a lot of sensibility and common sense prevails between nations so that businesses can come back on stream and life can continue as normal. Thank you for your time and your intelligence and your common sense. As always, it's been a wonderful exercise.
Thank you so much, Nilesh sir.
Thank you.
That, ladies and gentlemen, was Mr. Nilesh Shah, MD and CEO at Kotak Mahindra Asset Management Company, and of course an advisor on the Prime Minister's Economic Advisory Council. Thank you for watching us, but news continues on the other side of this break. Please stay with us.
From how the markets move today to what's setting the stage for tomorrow. From tariffs